So in our last video, we looked at using a whole life insurance policy to buy and sell real estate. We touched on why a lot of real estate investors use the product, how they use it, why they're attracted to it. We're going to look at some specific examples in this video and the next. Let's have some fun. So specifically, what we will look at here in today's video is a direct policy loan. And what we're going to look at is a policy with a loan interest rate of 4%. This is a variable loan rate, so it can adjust over time. In the next two videos, we're going to look at fixed rates, both at 5 and 6%, which will be interesting. So let's dive on into it. We did sample this particular scenario in our last video. So before we just dive into the actual growth and loan scenarios, the most important thing to do when you are looking to use a policy. So if you're interested in using a cash value life insurance policy for the liquidity benefit, remember that money's always compounding, you want to use that potentially for real estate investing, here's exactly what I would do. If you and I flip positions and I'm you just with the knowledge I have on cash value life insurance, what I would ask to see is exactly this. What does my policy look like when I just pay money into it and let it sit and grow? This way I can see if it's maximized for cash value. If it's not maximized for cash value, I can be laser focused on the growth and flexibility first. This way I see exactly how it works, make sure it's set up perfectly from the get-go, and then transition into the loan scenarios. This can be a lot of information to absorb, just any aspect of whole life insurance, which you may know, especially if you're new to all of this. So just as far as a step-by-step process, how do I absorb everything and make sure I really understand it? What I would do, this is just my recommendation, start with growth and then progress into loan scenarios. When you look at loan scenarios, see exactly what it looks like when you've got the growth on one side and then the loan scenario right next to it. This allows you to see the direct impact of that policy loan, and it can make things much more transparent. Because when you look at life insurance illustrations, what they will look like is this. So here's an illustration that just represents the growth. We're going to look at a loan illustration as well, but it is complicated. So here we've got a 40-year-old male. If this is me, my question would be this: where is my money going? Because I've got $100,000 per year going into the policy under my annual net outlay column. Total cash value represents the total cash value. First year, I'm at 89.5, almost 90% of what I've paid in. And there's my total death benefit, just under $1.5 million. Where we came up with that number, that was the minimum death benefit he needed to attain a $100,000 MEC limit. So the death benefit has a direct relationship to the MEC limit, keeping my policy tax-free all the way through. So as far as the design of that policy, up here you'll see it. Here's my base premium. Underneath that, you'll see your paid up additions rider. This is with MassMutual. This particular example, they use the term, one of their PUA riders is AILR, which stands for Additional Life Insurance Rider. It's another name for their PUA rider. And then below that, let's put this in purple. You've got their term insurance rider, one of their term insurance riders. A lot of times we'll use their LISR rider, which is a one-year term rider to provide flexibility. In this example, we did not. Term cost is $1,345 per year. So just about $1,350, which is a level premium for the first 10 years. It does not increase based on MassMutual's current expenses. They reserve the right to increase it. However, it should remain level for the first 10 years. I did say should on purpose because it's not guaranteed. All right. So let's take a look here at the funding. If this is you, this is a growth illustration. Annual outlay, total cash value. You paying $100K per year. Year one, you've got less than what you paid in. Year two, you paying $100,000 again. It was $89,000. What is it now? $186,000. So if you had $89,000 in a bank account earning 0%, you put another $100,000 in there, what would it grow to? $189,000. It didn't grow to that here. Got a negative hit. It appreciated to 186. It didn't appreciate. We lost money. The reason why first 2 years are the worst years with a whole life insurance policy, we are satisfying the insurance expenses. The next year, however, year 3, I pay 100 in and I get more back than what I have paid into the product. It gets better and better each year. So by year 4, in this example, I have paid in a total of $400,000 and I have $400,000. That's my break-even point. A lot of real estate investors, a lot of business owners are often laser focused on that upfront cash value. They're attracted to this asset for those core benefits. Cash value life insurance is safe, liquid, tax-free. The liquidity and having the access to cash value to take advantage of opportunities when they arise is extremely appealing to them. Knowing that the policy is going to produce a net internal rate of return somewhere between 3 to 5%. Like, it is what it is if everything's set up properly. So here's the illustration that we just looked at here. We put all of this on Excel. Before we go to the Excel comparison sheet, what I want to touch on here is as follows. So here's the values over time, appreciating. Got your cash value column here, year 10, you're almost at 1.2 million, and it continues to appreciate. Let's take a look at our loan illustration. So here, exact same policy, and you can see this actually for the first 4 years or the first 5 years before we take a loan, those values are identical. But year 4, that was our break-even point. I paid in a total of $400,000 and I have $400,000. Everything is identical in this illustration except for this guy. Annual loan, $500K. So that's the loan we actually take out here, $500,000 loan. Why I don't like the illustrations to look at these side by side is they can be confusing. We take out a $500,000 loan, we've got the annual outlay column that reads negative $400,000. The reason why is because we still paid in $100,000 this year, but then we took a $500,000 loan, so the software computes this as, okay, you got a net of $400K back because we're accounting for the $100,000 payment you made. So yes, I can explain that to you if I'm talking through all of the details. However, I like to lay things out side by side on Excel, just my personal preference. We can obviously work with you however you'd like if you choose to work with us. So there's your net cash value when the loan is taken. We are paying loan interest only for the first 5 years. So that's years from when we take the loan through year 10. That's why that loan balance does not increase. You're still making the $100,000 payment, plus you're paying loan interest. So you've got a $500,000 loan at 4%. What does that come out to? $20,000. That is why the annual outlay column reads $120,000. It's accounting for the $100,000 premium and PUA payment you've made, plus the loan interest. So detailed illustrations are beneficial because they're compliant and they give us all of the detailed information that we need. They're also confusing. So what we like to do is provide the full illustrations, but then in addition to that, simplify things. So let's take a look here. What we'll take a look at first is the growth illustration we just looked at, but what we will include here is the actual internal rate of return. And we're going to look at the annual IRR. So here, same payments. This is the exact same illustration. There's your break-even year 4. Annual IRR. So this isolates what the policy is growing by each year, not the average internal rate of return. That'll account for all years, obviously, but just to the annualized IRR. And why we're only looking at it in this example is because when we isolate the cost to borrow, what I'd like to focus on in this video is what am I earning that particular year versus what am I paying in loan interest that particular year. We'll do the same thing with the 5 and 6% fixed rates when we get to those. So if we look at this, the annual IRR, when do I hit 4%? Year 10 in this example, assuming the dividend does not change at all, which it will. And really what's important is tracking the actual performance, which we've got other content on that. But when I look at the annualized IRR, year 10, I've got 4.08%. Now, what you can look at, what some people like to consider is, all right, if I've got X amount of dollars in cash value, year 6, I've got $636,000 in cash value. I'm going to take a $500,000 loan. What's the impact of that loan? Or first, when I actually request that loan, how much can I take? Like I could take that $500K out here, and the reason why is because you had $630,000 in cash value. Your available cash value to take additional loans then drops to $116,000. So I see a reduction there. The death benefit drops by about $500,000 as well. So anytime I take a loan against a life insurance policy, I will see a reduction on the death benefit. Remember that the company is going to continue to pay me dividends and interest on any money in cash value and the outstanding loan balance. I'm still receiving compounding on the full cash value over here. No lost opportunity cost. This is often appealing to a lot of people. So, let me finish that thought. Why they do that is because the death benefit's being collateralized. I also do have a cost to borrow as well. Just like taking a line of credit against a piece of property that you own, assuming the property does nothing but appreciate over time. So here's the 4% cost to borrow. Year 6, you take that loan out. Year 7, really year 6 through 10 here. First interest payment is in year 7. Year 7 through 10, loan interest comes due of $20,000 and I pay $20,000. The returns are good to look at here. And you'll see where I'm going. So the return, or the cost to borrow 4%, year 6 or year 7, the IRR on the full cash value is 3.64%. So I can look at returns. What I can also do here, which I've come to appreciate, just simplifying things, is look at the total cash value growth, because remember, you're still earning interest or receiving growth on your full balance and paying how much in loan interest? $20,000. So what you can do here, this will be fun. Let's see what your net dollar amount is. Instead of looking at the returns, what does the actual dollar amount look like? So there we go. And this will isolate the net growth each year. We're taking out our payments. So year 6, there we go. How much did the cash value grow by? This is the total growth, $20,836. If I take a $500,000 loan and my cost to borrow is $20,000, the actual loan interest, what's the actual spread that year? $830 in my favor. And the reason why, because I have not taken the maximum loan. I only took $500,000, whereas my appreciation is on the full $636. If I took a $600,000 loan here, the case would be the opposite, where I'd have a higher cost, meaning I'd be paying more in interest than what I'm actually receiving. So looking at the dollar amounts doesn't hurt. I like to do it. It's pretty easy to do when we just crunch the numbers here. Have some fun. Compute that. There we go. So there's our total cash value growth. Let's do one more thing here, which will be valuable. And here's what we want to look at. Let's look at the total interest payments. So how we can do that, just the interest. So what's going on here is on the far right, we're going to tally up all interest payments you have made over the years. So in this example, year 7, $20,000 in loan interest comes due, and all you do is pay the loan interest. You apply nothing toward the principal this year. And you can do this kind of stuff with a life insurance policy. You can even elect not to pay anything if you just want to defer payments altogether and then begin to make payments once you've stopped funding the policy after the 10th year. And we measure this kind of stuff as the years pass. But there's the $20,000 loan interest amount. There's the payment. So you pay interest only and then begin to apply an additional $100,000 per year toward the loan principal. The reason why is because we're no longer making premium payments at that point in time. We're only applying funds toward the loan balance. So here's what I want to look at. Total loan interest we've paid. How much? 140 grand in total. And that's paying interest only for a while. Obviously, if you applied funds toward the principal quicker, we'd pay that down much faster. But 140K in total interest that went to the insurance company. Now, if we stop there, can make it seem like we've paid interest on our own money. But let's take a look at our cash value and death benefit when it's paid back. $1,507,000. What are your values in the example when you don't pay it back, or I'm sorry, when you don't take a loan at all? Let's take a look here. 1507, that's year 15. 1507, and there's your IRR. You can see that actually, if you want to rewind a little bit, just look at the full illustration, you'll see the exact cash value year 15, that figure right there, 1.5 million and change. So this is what is referred to as a non-direct recognition policy. And really what that means is that the insurance company does not recognize non-direct recognition. They do not recognize the fact that we take loans against the policy and continue to apply the same dividend rate on any money in cash value and what we've loaned against it. So let's continue on here. What happens here? So this is a repayment scenario. What happens if you can't repay it? This is a good thing to look at. Let's first look at you paying interest only. So the exact same scenario here, same growth scenario, same $500,000 loan, but in this example, we're going to assume that you never pay it back, the principal that is, and just pay the loan interest each year. So what happens as the years pass? You continue to pay $20,000 in loan interest, and you'll notice that the cash value is always on the illustration $520,000 less than what it is in the example when you never took a loan in the first place. Same thing with the death benefit when you look at that. So if you were to repay the loan, in this particular example, let's say it was age 65, you say, I'm just going to pay this full $500,000 back. Death benefit would be restored to the 3.5 million, and cash value would be restored to the 2.45 million. Assuming dividends stay consistent over time, the actual values will differ, but you'll see everything restored in this case when it's paid back. When we look at a no repayment scenario, let's take a look at this. Your funding on the left. So in this example, let me start at the top. The loan interest comes due each year, and this assumes we do not pay the loan interest at all. We just let it ride. How loan interest accrues is at annual simple interest, meaning it does accrue at simple interest only over the course of 1 year. It's from your policy anniversary date. So what that means is if I have a $500,000 loan and at 4%, that's $20,000, what would happen in a case like this, you would actually want to take the $20,000, divide it by 365 days, because it accrues at annual simple interest, it accrues daily. You could also just divide it by 12 months, on a monthly amount, and you get a little over $1,600, that much per month. So what you'll see here is $1,600 per month added to the balance or accruing in loan interest. And if you don't pay any of it, after the course of 1 full year, it'll accrue to the total of $20,000. Now let's assume, for the sake of simplicity, you pay the loan off in full after 6 months. What would happen here is you'd have $10,000 in loan interest that has accrued because it's simple interest over the course of the year. Now, when that loan interest comes due, if you don't pay anything back, the loan interest comes due, you don't pay a penny toward it, what'll happen is the policy will take a loan against itself to cover that loan interest. As a result, it begins to compound. So my loan balance accrues to $520,000. I don't pay the loan interest. What'll then happen, the policy will take a loan against itself to cover the loan interest. So the policy is going to pay for that loan interest. It's going to borrow against the cash value to do this. So it will cause or create drag on your policy, if we want to think of it that way. The main reason why I refer to it as drag, is A, my loan balance is increasing because that loan interest will compound over time. It is simple interest only each year. If I don't pay at my anniversary date, it's going to compound. And that's going to slow the cash value growth down. Now in this particular case, I will still see positive appreciation. And the reason why is because I've paid in $1 million. I took out half of that, $500,000 in the form of a loan. I'm still earning interest, dividends that is, on the full 100K. So I've only borrowed out half. The interest earned is going to outpace the loan balance there. But it keeps on growing as the years pass. Year 50, I've got almost $4.8 million in cash value based on the present dividend rate. However, in the example where I don't touch it, I'm at $7.7 million. That's a big impact from a $500,000 loan. Now, if you did pay that off, let's say you sold a piece of property or received an inheritance and pay off that $2.8 million loan, your cash value would be restored to what it would have been otherwise. So I do continue to receive dividends and interest on my entire cash value as if I never touched it in the first place. Interesting stuff. So just to kind of wrap this guy up, how people will use these policies, real estate investors specifically, typically safe area to position money. They've got the guaranteed appreciation. And then when opportunities come around, they will take a loan against their policy to invest in property. That's really what they're doing. Instead of going to a bank and dealing with all of the rules and regulations and slow turnaround time underwriting they have to deal with, this is the appealing part. And a lot of people we work with do both. So I mean, it's not to say one's better than the other. It's just having all means at your disposal. Hope you enjoyed this one. If you did, please hit the like button, subscribe for more. And if you have any questions, leave them in the comments below. I do check those and answer them as often as I can. Thank you so much for watching. And as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.